In previous video, we explained the asset. Now it's time to move to the next component, which is liability. What is liability? Liability describes all debts or obligations for a company that have to be paid in a specific maturity, as an instance, banking loan or rent or wages. Like asset, liability has several subdivisions like cash, account payable, short-term loan, accrued expenses, unearned revenue, and long-term debt. Certainly, there are more components for both asset and liability, but these mentioned are the most important one. Now, what is cash in liability? Cash in liability describes all amount of money we have paid in exchange of some goods and services, like pay for utilities or pay for rent. The second one is account payable, which is the opposite of account receivable and describes the amount of money we have to pay in a specific maturity for some goods and services that we have gotten them but not yet paid, like purchasing machinery for $200. Following that, we come to the short-term loan, which is clear enough for you. It's defined a kind of loan that are going to be paid back in short term, means during a year. And next one is accrued expenses. Accrued expenses define costs that have been incurred but not yet paid or recorded in financial statement by the end of the accounting period. So after these explanations, let's clarify the difference between accrued expenses and account payable. For the first one, accrued expenses, we have to say it covers all amount of money we have as debt but the invoices have not been received yet. And these transactions are going to be paid when the invoice is received. Also, it doesn't have a specific date of payment. The second one is account payable, which covers all debts for goods and services that the invoices have been received and recorded and have a specific maturity date, unlike the accrued expenses. Now let's clarify more with some examples. For the first one, we have accrued expenses, which the example is accrued wages, which means workers work about half of a month, but payday is at the end of a month. So when you want to record transactions for accrued expenses, you have to record them as accrued expenses. And the second example is accrued interest, which means interest has accumulated but not yet been paid. And for account payable, we have office supplies and utilities. The next one is unearned revenue. This one describes advance payment for goods and services that you have gotten it in exchange of future deliveries or services. This is like prepaid expenses, but for another side of this deal, means customer. As an instance, your customer prepaid expense is $200 for your product. This $200 will be recorded into your financial statement as your unearned revenue, and also this $200 will be recorded into your customer financial statement as prepaid expenses. Quick reminder here, like asset, the listing rule includes liability too, but unlike asset, liability components are recorded and listed by maturity. Which one has closer maturity, we write down on top of the list, and which one has longer maturity on bottom of the list. Liability is divided into two categories. The first one is current liability and the second one is long-term liability or non-current liability. The first one, current liabilities, are a company's short-term financial obligations that are due within a year. Some subdivisions are cash, account payable, short-term loan, unearned revenue, and so on. The second one is non-current or long-term liabilities, which means a company's obligations that are due within more than a year. Some common examples are long-term loan, mortgage payable, bond payable, which means debt securities issued by company, and the last one is lease obligations.